to another tutorial video. This time around, we're going to take a break from some of the case studies based on real companies that we've looked at before and look at instead a type of exercise that you might have to complete in an assessment center or even outside of this, just in the scope of normal interviews. So these types of M&A exercises and case studies are very common if you're in a region like Europe, the Middle East, Asia, where assessment centers and practice exercises like this are quite common. And what they will do typically is give you a set of financials for company A and for company B. And here they're giving us the projected 3-year financial information. And what they do is they give us a couple scenarios where we have to calculate the accretion dilution. So scenario number 1, we have an all share transaction, all stock transaction. Scenario number 2, it is basically an all debt transaction. They call it all cash, but we raise the cash through debt. So effectively it's a debt deal. And then scenario number 3, we have a mix of shares and cash. And so our task in this case study is to go through and look at what the accretion dilution numbers look like, depending on the premium that company A pays for company B, and then the method of purchase, whether it is cash or shares or a mix of both. And then we have this optional part at the bottom that we can present our results in the form of sensitivity tables and highlight the relevant scenarios. Of course, that is optional, so we're not going to focus on it too much here. Now, in terms of the assumptions they've given us, so we have synergies here. So these are going to be a percent of the seller's revenue, a percent of company B's revenue. For the cost of debt, so the interest rate on debt, we have LIBOR plus 500. Really, this means 8.25% because LIBOR is 3.25%, so we have the interest rate from that. And we're not assuming anything, we don't have anything for principal repayments here, so we're just going to assume those are zero and assume the debt balance, whatever is raised in the form of debt to do this deal, stays the same each year. Now, for the financials for company A and for company B, here's what we're given. We are dealing with European companies here, so the financials are all listed in euros. So for company A, we have their revenue, EBITDA, EBIT, and interest expense. We have their tax rate, we have their market cap, net debt, and share price. So based on this, we can get to a lot of other numbers. For example, they're not giving us the net income for company A, and of course we're going to need that because to calculate accretion dilution, company A is our buyer. We need to look at the difference in earnings per share, net income divided by the share count for company A before and after this deal. So we're going to have to calculate some numbers. This is not everything we need. We're going to have to go in and take these numbers and calculate a few additional things based on this. And then for company B, we have a very similar setup, except the numbers, of course, are different. So company B is a lot smaller, has a market cap of 22 million euros, and then their revenue figures are also lower. Their share price is different. Their tax rate is different. So a whole lot of things there are different for company B. So when you get a case study like this in real life, what do? Well, I've divided it into a 6 or 7 step process, which you can look at, actually an 8-step process, because we're going to look at some key takeaways at the end, which you can look at in the accompanying Excel file here. So step number 1 is to read and interpret the instructions and understand where to cut corners. So in addition to going through this and getting all the numbers, what you have to think about as you go through it is what do you actually need to complete this model? Because if you wanted to, you could make this extremely complicated, but presumably they've given you a time limit here. So you only have 15 minutes or 20 minutes or even 30 minutes or something like that. And so you're not going to be able to make this terribly complicated in a strict time limit like that. Now here, from the instructions, we know that since we have to analyze the company and the deal at different premiums, we have to be able to change the purchase price. We also have to be able to change it from a stock deal to a debt deal and change the percentages on those. But they never ask us to look at the deal if we use cash on hand to fund it. So it's not necessary to build that in. We can just make this debt and stock and leave out the cash and the foregone interest and cash entirely. Also, as I mentioned before, they've given us some incomplete information, so we're going to have to go through and calculate some of those figures for company A and company B. Like the shares outstanding, we don't have that. We're going to need it for accretion dilution. We are going to need net income at the very minimum for company A, so we're going to need some of that additional information. And so these are the things you want to be thinking about as you read the instructions like this. We're skipping the formatting here for the most part. It doesn't need to look pretty. In an extreme time pressured case like this, forget the formatting, get to the right answers and give them the right numbers. That's what matters most. So for the actual case, here's what I recommend. For the first step, or really step 2 here, you want to enter the financial information for company A and B first. Then you want to calculate the missing information like net income, earnings per share, and the share counts. Then you want to go up to the top and enter your key assumptions such as the purchase price, the amount of debt and stock used, and the interest rate. Then you want to combine the income statements for company A and B. All we're asked about is accretion dilution, so we're not going to worry about the other financial statements because all we have is the income statement here. Then we're going to calculate accretion dilution and the pro forma credit stats. create sensitivities if you have time, and then part 8, step 8 here, we're going to look at some of the key takeaways from this lesson. So key financial information, we have actually already entered it here, so we don't need to do anything for this step. If we didn't have this, then what you'd have to do is go back here and then manually enter the numbers that they have given us. But here, to save some time, I have skipped this entirely. So we're going to move on to step number 3, which is calculating the missing information. So net income, earnings per share, and share count for both these companies. Let's take a look at how we do this and start with company A. So we have their EBIT and interest expense, and if you subtract the interest expense from EBIT, you can get to our pre-tax income for company A here. So let's do that. EBIT minus interest expense gives us our pre-tax income. Now, what is our net income? Well, it's going to be equal to our pre-tax income times 1 minus company A's tax rate, which I'll anchor to make sure that doesn't move around. You have that. And then for the earnings per share, so this is just our net income divided by company A's share count. Of course, we see that we have a problem here, which is that we don't have company A's share count right now, so we need to go in and calculate that. How do you calculate the share count for company A when you don't have it? Well, you know their market cap and you know their share price, so all you have to do is take their market cap, divide by the share price, and get to their share count of 17 million shares here. These units are in millions. I've just labeled it that way to remove any ambiguity there. Now, the earnings per share, we don't know if the share count is going to be different in each year, but in the absence of further information, all we can really do is assume that the share count here stays the same. So let's take our net income, divide by the share count, anchor that with F4 once again so it doesn't shift around, and we have our earnings per share, which is just under €1 per share, going up to closer to €1 per share by year 3 here at the end. I'm going to fix the labeling there as well. Then for company B, so let's go in and do the same thing. Let's take our EBIT and subtract our interest expense here. Net income, same idea, pre-tax income times 1 minus the company's tax rate of 40%. Copy that across. Earnings per share, again, we need the share count, so let's take our market cap, divide by the share price, 1.5 million shares, and then earnings per share, net income divided by that share count. I'll anchor that with F4 and copy that across. So earnings per share is significantly higher for company B. Why is that the case? It's mostly because the share count is much lower. If you look at it, their net income is not really that much different from company A's, but the point of this is that their share count is a lot lower, and so their earnings per share is a lot higher as a result. We can also go in and calculate the enterprise value for both companies. We don't really need it for this case study, but let's just take the market cap, the equity value, and then add net debt, and then do the same thing for company B. So we have that in place. Again, not necessary, but we just like to have that on hand just in case it comes up later on. So we've calculated this missing information. Now let's go to the top and enter the key assumptions, starting with question number 1. I'm saying question number 1 here because when you have this area at the top for assumptions, you want some kind of reference. You don't want to just enter blanks for everything. You want to be able to actually reference something and make sure that you're using the right numbers as you go through and do this exercise. To save some time here, although the question is framed in terms of premiums to company B's share price, if you think about it, we can just look at it in terms of the premium to their market cap instead, because company A has to acquire all of company B's shares. So really, it makes the same difference either way, and we save some time by just looking at the premium to company B's market cap instead. Let's go up and fill in this information now. And let's go back to our case study, our Word document. So we have a nil premium, 0% premium, and then a 20% premium. I'm going to enter 20% for now. And then for the purchase price, so what we can say is, let's take our market cap over here and then multiply by 1 plus this premium to make sure it works out as intended. So 26.4 versus 22, and it seems like this 20% premium is being reflected. Now, in this first scenario, this is an all-share transaction, so we're not going to have any debt. So for the debt used, I'm going to enter 0%. For the stock, I'm going to make this equal to 1 minus the percent debt that's used. So if we change this to 50% debt, this becomes 50% stock. If we change it to 30% debt, this becomes 70% stock, but I'm going to leave it at 0 for now. What else can we enter based on this and based on these assumptions? Well, we want to enter the synergies and also the cost of debt here. So synergies, 5% of target sales, 25% in year 1, 50% in year 2, and then 100% in year 3. Let's enter some of that. 5%, 25%, 50%, and 100%. Then for the debt interest rate, so we could do this in a couple of ways. I'm just going to enter this as 3.25% plus 5%. So it's 8.25%. Then for the debt raised here, so since we have the percentages for the debt and the stock that are being used in this deal, we can calculate the amount of debt raised in euros and also the number of shares issued in millions here. So for the debt raised, let's take our percent debt and then multiply by our purchase price right here. And then for the shares issued, so you have to be careful about this. What you want to do is take the percent stock used times the purchase price and then divide by the buyer's share price down here, because the buyer is issuing its own shares. There's no guarantee that the buyer's share price is going to stay the same, of course, but we don't have any information to the contrary. So in the absence of further information, we are going to assume that the buyer's share price is the relevant metric here, and they issue shares based on their current share price. So shares issued of 5.28 million right there. So we are now done with step number 4, going up to the top and entering the key assumptions. Now what we want to do is move to step 5 and calculate or combine the income statements for company A and company B. We're going to start with synergies because that is the part that's different, or that's a line item that doesn't exist in the separate income statements. Then we'll factor in all the other items and basically add them up. Then we'll factor in other acquisition effects like the additional interest expense and also the shares outstanding, the new shares that get issued. We'll go down to EPS and make sure that we actually include the new shares in that calculation. So let's go over here. Let's start with the synergies. And for this one, what we want to do is take company B's revenue over here. We're going to multiply by the 5% and anchor that so that doesn't move around. And then we're going to multiply by the phase-in percentage over here, the 25%, 50%, and 100%. I've anchored the 5%, but the others I have not anchored because we do want those to be able to shift around and to be able to move left and right as we fill this out. So we have that. Now for the total revenue, we are going to take our synergies here and then add company A's revenue and then company B's revenue. They've acquired 100% of the company, so we're just going to simply add together 100% of the numbers for both companies here. We have that. Then for the EBITDA, so this part you have to be careful because what you have to do is look at the difference between revenue and EBITDA for company A and then the difference between revenue and EBITDA for company B and factor all those expenses in when you calculate this number. So what we're going to say here is we'll take our revenue and then we're going to subtract company A's revenue minus their EBITDA and then company B's revenue minus their EBITDA, because that gives us the total expenses for both companies here. Let's copy that across. And then for EBIT, so we can do pretty much the same thing. Let's take our revenue first and then simply take company A's revenue minus their EBIT. That gives us all their expenses down to the EBIT line item, and then do the same thing for company B. Take their revenue minus their EBIT right here, and that gets us everything. And I used the wrong sign. Let me change that to a minus right now. We have that. So then for the interest expense, we're going to take the interest expense for company A and for company B. Then we're going to add the debt raised, anchor that, and then multiply by the debt interest rate right there and anchor that, and copy this across. How can we test if this actually worked? Let's change the percent debt to 50%. And now we see the interest expense is much higher here as a result of that. So this appears to be working properly. I'm going to change this back to 0% debt for now. Next, pre-tax income. So we're going to take our EBIT and subtract our interest expense. Then for net income, so you have to be careful about this. You always want to use the buyer's tax rate for this, not the seller's tax rate, not a blended tax rate. You're always using the buyer's tax rate. So we're going to take our pre-tax income, multiply by 1 minus the tax rate right there, anchor that, and then copy this across. Then for the share count, we're going to take company A's shares. We're going to anchor that so it doesn't shift around, and then add the number of new shares that have been issued in this transaction, anchor that because that's not going to shift around. Company B shares are irrelevant. They all go away in this deal. So their share count goes to 0. They have no equity left, no shares left, because company A has acquired all of it and replaced it with these new shares that have been issued. So that's all we're factoring in into this analysis. You have that. And then for the EPS, let's take our net income, divide by the share count right here. And so we have that. So upon first glance, we can see that clearly it is higher than the buyer's old EPS figure. So this is going to be an accretive deal, at least in question number 1. So we have all that calculated. We are done with step number 5 now. And then let's go to step number 6, calculating accretion, dilution, and the pro forma credit stats. Accretion dilution, pretty simple. We just take the combined company's earnings per share, divide it by the buyer's earnings per share, and subtract 1. For the credit stats, as I say right here, all we have here really is net debt, EBITDA, and interest. So there's nothing on CapEx, working capital, total debt, free cash flow, nothing like that. So all we can really say is net debt over EBITDA, and then the coverage ratio, EBITDA over the interest expense in this case. do not overthink this part of it. A lot of people get into trouble in these case studies when they start overthinking it and start thinking about all the other possibilities, all the other things they could add. But if you don't have the information, then you cannot do anything. So do not overthink it and calculate the numbers with what you have available. So let's go up and actually make these calculations now. So for the accretion dilution, let's take the combined company's EPS, divide by the buyer's standalone EPS, and subtract 1. We have that. Then for the pro forma credit stats, so what we want to do here is take the buyer's net debt and then the seller's net debt. Now, the reason why I'm adding the seller's net debt is because we don't know if the buyer has actually paid that off in the course of this deal. In fact, we're effectively assuming they haven't paid it off because all they pay is a premium to the company's market cap. So we're assuming that they haven't refinanced the debt, they haven't paid it off, they've left it on the combined company's balance sheet, and that's why we're adding up the numbers here. We're also going to add the debt raised, and we need to anchor all these numbers with F4, and then we're going to divide this by the annual EBITDA over here. So 1x going down to 0.8x, and then for the EBITDA over the interest expense, so this is pretty easy. EBITDA divided by interest right here, and so we have the credit stats like that. So what is the next step now? Well, if we wanted to, we could go in and create sensitivities if we had time. As I say here, we would argue that it's pointless here because it takes more time and effort to set them up. It's not really going to save us much time beyond the model that we already have. We can simply copy and paste in the answers to all the exercises now. If we wanted to copy and paste in all the answers, what would that actually look like here? Well, let's go back up to question number 1 and start figuring this out. And what we can do here is just copy and paste a lot of these down below each question just to save us some time. So nil premium and then a 20% premium in an all share transaction, and then the pro forma credit stats in both scenarios. So let's change the premium, keep this at all stock, and then let's just copy and paste both scenarios here. And again, this is really the 80-20 solution that I'm giving you because you don't want to spend hours and hours or minutes and minutes on this in a real case study. Change this to a 20% premium, and what happens? Let's go down and copy this in right here. So obviously the accretion dilution is lower at a 20% premium. The credit stats are actually about the same here, which is interesting. And the reason that happens is because we're only looking at net debt, EBITDA, and interest. And in an all-share transaction, of course, the credit stats are going to stay the same because we're not using any debt. That's not changing at all. Of course, the accretion dilution is going to be different because the share count here is going to be different in an all-share transaction. So let's go to the next question, question number 2. So now we have an all-cash transaction. So it's 100% debt. We want to look at this at a 20% premium and a 40% premium. And again, show the credit stats for both of those. So 20% premium, let's change this to 100% debt. And let's go down and copy in these numbers now. So this will be for scenario number 1. And then for scenario number 2, we need to change this to a 40% premium. And again, accretion dilution is lower. And of course, the credit stats also change this time around because debt is involved. So we have that. We can see the accretion dilution is lower. The credit stats are higher when we pay a higher premium here. Why is that? Well, again, this is not a good thing. It's actually a bad thing that we have more debt and that the EBITDA to interest number is lower because it means we're closer to not being able to repay the interest, although it is very high here. The reason this happens is because when we use 100% debt and we pay a higher premium, not only will the accretion dilution be lower, but the credit stats will also look riskier for us because we're using more debt. We have now more debt on the combined company's balance sheet now as a result of doing this. Then let's move down to scenario 3 and paste in the answers to this one. So a mix of shares and cash, and we have a 20% premium, 30% cash, 70% shares, 40% premium, 80% cash, and 20% shares. Let's go up and enter these assumptions. So 20% premium, and then we have 30% debt, 70% stock. Let's go in and copy and paste this. We have that. And then for scenario number 2, 40% premium, and then we have 80% debt and 20% stock, matching the case study assumptions. Let's go in and copy and paste this. So what is this telling us? Well, in the second scenario, we have a more accretive deal even though we're paying a 40% premium. So think about that. 40% premium, but accretion dilution is actually higher here. So it's more accretive despite that. Why is that the case? Because generally speaking, stock is more expensive than debt. And in this case, we're using more debt and less in the way of shares. So of course, the accretion is going to be higher. Not always the case, depends on the numbers, but we're not surprised by this result here. However, what is interesting is that the credit stats also look worse here. So our debt to EBITDA ratio is higher. Our EBITDA to interest ratio is lower than it is in this case. So this is just sort of illustrating the trade-offs of doing a deal like this. Yes, you can get to higher accretion even if you are paying more for a company, because if you pay more using debt, often it'll be more accretive. However, there is a trade-off, which is that the credit stats also look worse if you use more debt. So really depends on what the buyer is going for, what they're planning to do, what their goals are for the future. And really the point of this case study is that there are trade-offs to all these methods, whether you're looking at accretion dilution or credit stats as we are here. So that's really it. We have all the answers to this exercise now. What I want to do very briefly is just sum up what we've done and then go into part 8 here, which is what is the point of this case study exercise. Well, takeaway number 1 is, as I just mentioned, is even if we pay a higher premium, the deal might be more accretive depending on the purchase method. If we use more debt, often it'll be more accretive because debt is almost always less expensive than stock. Takeaway number 2 is that company B is just very cheap in general. And when a more expensive buyer acquires a less expensive seller, the deal will almost always be accretive. And especially in this case, because there's a huge difference between them in terms of multiples. We'll look at that in a little bit. Company B also has a much higher tax rate, which also makes a difference. Company A's tax rate is 25%. Company B's tax rate is 40%, so that's going to make a difference as well. Just to illustrate what I mean about Company B being cheaper, take a look at something like their PE multiple. So their market cap divided by net income right here. 2.4 down to 1.67. That's ridiculously low. Let's take a look at the EV to EBITDA multiple. So enterprise value divided by EBITDA right here. 1.52 going to 1.14. That is a really, really, really cheap company. Now, if you look at company A's numbers, so their market cap divided by their net income, 6.3 to 5.4, still on the low side, but a whole lot more expensive. And then if you look at their enterprise value to EBITDA multiple, 4.2 to 3.79. And this tells you, in effect, why the deal works as it does, because company B is just a whole lot cheaper than company A for some reason. So that's it for our case study. To recap what we did here, step number 1 with a case study like this, read and interpret the instructions, figure out where to cut corners. Then you want to enter the financial information for company A and B if it isn't already provided. You have to calculate any information that you're missing, like net income, earnings per share, and share counts here. Then you want to go up to the top and enter the key assumptions. Start with question number 1 so you have some numbers to use for them and so you can check it along the way. Then you want to combine the income statements for company A and B as we did, calculate accretion dilution and the pro forma credit stats with the information you have available. If you have time, create sensitivities. We skipped it here. And then Part 8, in case they ask you about this, take a look and reflect on the numbers, see what they're telling you, and then draw some conclusions from that just so you can discuss it, or in case it comes up in a group case study or exercise like this and you're asked to discuss the results.